let's take a look at this. These are, now remember I said governmental funds and then the governmental wide statements. Let's take a look at the first ratio. These are revenue measures. Revenue per capita, operating revenues divided by population. Is this number better, higher, or lower? Yeah, right? What happens if it starts to go down? A concern, right? Operating revenues divided by population, right? So if your operating revenues fall, what happens to the ratio? It also drops. Okay, yes, it could be that, or, industry leaving town, for instance, right? How about one-time revenues? Would you like to see a higher or a lower number there? What is it? Lower. We don't want one-time revenues. If you have one-time revenues, that tells you there is an issue. If 50% of your revenues come from one-time sources, you're in trouble, right? So as I talk about this, I want you to, in your mind, think about what's good and what's not good, because this is one of the exercises I gave you for the homework, okay? Let's go to the next one. Now we go from revenues to expenditures. A higher number under revenue was good. What do you think for expenditure? Is that good or bad? A higher expenditure per capita. It's not really good. If your expenditure per capita are increasing more than the rate of inflation, there's a problem unless you have something going on. Everybody understand the meaning of per capita, right? The word per capita is anytime you use population. Anytime you use population, it becomes per capita or per person. Okay? This is what they are spending per person, expenditure per person. Employees per capita. Now this is an interesting question. Number of employees divided by population. It could be good if you're one of those. Right? Okay. But mostly people don't want to see high number of municipal employees per population, right? Okay. Is everybody got that, right? So, okay. These are operating positions. So we looked at revenues, expenditures, and now operating surplus. Operating surplus. What do you think? In the first one, how would you evaluate that? Let's look at the surplus first. Don't assume the word deficit doesn't exist there. Operating surplus divided by operating revenues. What would you say to that? Well, what you want is some amount. You don't want a lot, because if you have a lot, that means what's happening? People are paying a lot of taxes, right? But what happens if it's a deficit? Do you want a deficit over operating revenues, a high operating deficit? No, definitely not. Fund balance. Now, this is a tricky question. And this is a question which everyone is faced with in government. What should your fund balance be? Now, I want you to think about fund balance as the rainy day fund here. Let's take the case of New Jersey or another state. Let's say your budget was, take New York City, $50 billion. And you're expecting revenues of $50 billion. Are you going to get exactly $50 billion? You know you're going to spend $50 billion, which you will probably. But how about raising that money? Should you build in a little fund balance in the event you get $49 billion only? Yes, you have to have something. A rainy day fund, right? The question is, how much of a rainy day fund? 2%? 5%? 10%? 1%? There are states like New Jersey which have less than 1%. And then there are other states which have healthy numbers. Question is, what should it be? Well, let me ask you, what do you think it should be? Your rainy day fund balance. This is your little savings account squirreled away in case you don't hit your revenues. What do you think? You said 5%. 10%. Now tell me one thing. Rather than just a number, can you give me a reason for why you said 5 or 10%? Yeah.
I said 1 because the federal government will always get your back like Sandy.
No, don't count on that. No, that was a natural disaster. Federal government didn't come to the aid of Detroit when they went under. Yeah. Somebody else said, yeah. Why do you say that?
Because I'm taking into consideration maybe it's more expensive next year, so we'll get the whole 10%
Okay. Okay, that's one thing. Rising costs. But you know what? I wish I could tell you a number. There isn't any. But it's a problem because guess what's going to happen? If you don't have a rainy day fund, who's going to get hit? Taxpayers, and right away. So as a government financial manager, that's your responsibility. Make sure you have enough of a rainy day fund, which is there in the event something happens. And now you're caught. The credit rating agencies are saying, keep more of the rainy day fund. The taxpayer is saying, no, don't do that. Use it so our taxes could be lower this year. But that's the issue. That's with fund balance. Liquidity is an interesting question. What does it say, cash and short-term investments? Anybody remember what was the quick ratio again? Yeah, except the inventory. Okay. And this is similar to that, like the current ratio, where it's cash and short-term investments divided by current liabilities. Okay. Tell me, what would happen if this number is less than 1? We have a problem with solvency, right? Your cash and short-term is less than your current liabilities. See the problem? So it should not be less than 1. The question is, what should it be? Well, what you should have is normally, and this is from my experience, you should have enough cash to carry you over for the next 30 to 60 days. Always happen. 30 to 60 days, you should have enough cash to carry you over. Okay? But it shouldn't be less than 1. Long-term debt. Long-term debt as opposed to assessed valuation, or do you want a lot of debt? Some people love it. I don't like it, both professionally and personally. The best feeling, and this is now a personal comment, that a person can have, and believe me, I say this from experience, is to be debt-free. It's a wonderful freedom. Unfortunately, and again, this is not a commentary, just take it as a personal comment, our society does not promote that. But the best feeling in the world is to be debt-free. And this carries forward not only personally, but you see that with governments, almost 12 to 13% of the U.S. budget is used for interest paid. And that's today with low interest environment. 13%, I read, on interest payment, 27% on defense, 25% on everything else, and then 25% on health and education, something like that. So you can see how interest by itself is taking over 10%. So you don't want, obviously, that's what that is. Current liabilities divided by operating revenue. Interesting. This is requires you to think about this. Current liabilities, do you want them large or small? Small, right? So the question is, what should they be? So let's take a look at it. 12 months, right? 12 divided into 100 is approximately, so just let's say about 9% or so, right? 9%, right? So if you got a number here of 9%, that would mean what? You have 1 month of revenues, right? 1 month of liabilities, or 1 month of operating revenues which represent these liabilities. Basically, it's a cash flow question, which is, if you didn't have revenues coming in, how far can you go on? And as I said, again, it goes back to the 30 to 60 days. And most people would say, but I'm going to get the revenues all the time. Guess what happened at the shore communities with Hurricane Sandy? It wasn't just things closed down, but something else happened, which nobody thought would happen here. When those buildings got washed away, guess what the taxpayers did? Those people who owned those buildings. They went back to the town and said, you know what? We're paying taxes on land and building. Guess what? Building's not there anymore. We're not paying you taxes for building which was supposed to be there. All of a sudden, the town, which knew buildings could never move, now had what? Only land that they could tax, and there was no property. So not only did they suffer all this damage, what else happened? These taxpayers came in and said, sorry, there's no building. Can't pay you taxes on something which doesn't exist. And the towns, therefore, had to absorb that. And that's the reason why I mentioned that to you. Okay. Unfunded pension liabilities, I think we talked about that. You definitely, this is one of the biggest things. This is your net pension obligation. Okay. You don't want it to be increasing. You want to decrease or have it the same. Decrease is better. And the same thing is here with the liability for post-employment benefits. Capital outlays from operating fund. And this is an interesting question. A lot of towns and others don't want to spend money on capital until things are totally done and finished. They don't want to spend money on maintenance, which is sad. And why I say this is, most of you would say the less capital outlay, the better. I would argue against it. You should have a certain amount of your budget for capital items. Why? Because if you had it, you would keep the things in shape. If you didn't, you would replace equipment. You would do things like that. So this does not necessarily mean that by spending too much money on capital, it's a bad thing. You should spend a certain amount on capital items. Now, these are the government-wide measures. We moved from fund to government-wide, and these are relatively straightforward because